Well, hello and welcome back. If you aren't aware of what's cooking in the housing market for 2023, then you've landed on the right video. With inflation rates still higher than what the Fed wants it to be, interest rates driving mortgage rates through the roof, leaving Americans in a state of despair, and as a bonus, a looming recession upon us, we have a lot to talk about in this video, so let's begin. So it seems that it's not just speculation anymore. Even the Federal Reserve Bank Dallas has come out with the statement that there is a threat of a global housing slide that looms ahead of rising rates. That's right, it's going to be on a global level, folks. There is housing froth being seen, which is essentially a situation where there is an excessive increase in housing prices that is not necessarily supported by underlying economic fundamentals. We're seeing house prices go down in some countries, but what lies ahead is more than just a price decline. Specifically, if we talk about the U.S., the impacts are going to spill over to other countries because of the sheer size of the nation's economy. So we can say that it's going to deeply hurt the housing sector for sure. The Fed has been increasing the interest rates to try and manage, if not bring down, the soaring prices of basically everything. Just last year, they increased the interest rates 7 times, and it doesn't seem to stop anytime soon. And what does that mean? It means, folks, that we have a crazy high mortgage rate right now that stands at more than 6.5%. And let's not forget that this was 7% just a couple of days ago. Now, couple these high mortgage rates with the already out-of-reach home prices, now what you have is a housing market that is way out of range for so many Americans. If we look at the history of the U.S. house-to-income ratio, the average housing price has been 5 times the yearly income of an average U.S. household. But before the Great Recession of the late 2000s, when there was a housing bubble, we saw an increase in this number where it reached and even exceeded 7 times the average yearly income. Now, a typical U.S. household earns between $50,000 and $90,000 a year, and with high mortgage rates, taxes, and insurance all combined, they have to pay about $30,000 a year. This is about 43% of all of an average home income going into house ownership payments, which frankly isn't sustainable at all. This is exactly the reason why people are feeling helpless, and mortgage demand fell for a 3rd consecutive week at the start of this month, thanks to the increase in interest rates. In fact, there's a massive 28-year low mortgage demand right now, as the volume was 44% lower than the same week 1 year ago in 2022. Not only that, but mortgage delinquency, which means when homeowners are at least 30 days overdue on making at least one mortgage payment, rose at a rate of 3.9%, and the FHA loans particularly faced a 4.6% delinquency rate during the 4th quarter of 2022. This means people are defaulting on housing loans, with many more such cases to be seen this year. Talking about delinquencies, it's not just the mortgage loans. People are also falling behind in paying their car loans. Looking at this graph, there is a clear increase in the number of auto delinquencies, which stand at a whopping 6.05%. This is a never-before-seen figure and shows how bad the financial situation is out there. If you're interested in more of our informative content, do subscribe to the channel and hit that thumbs up button if you like this video so far. Now, let's continue. As the mortgage rates are rising, more and more houses are sitting on the market longer. Take a look at this chart. In January, a median house stayed on the market for 74 days, and in February, it only decreased to 67 days. Now, this number is higher compared to last summer when it was 30 days. So, the longer a house stays on the market, the more price depreciation occurs. This drop in the prices may look like a happy thing for prospective homebuyers, but the overall economy is going to take a hit. This unaffordability is a serious indicator of a recession that may even have already begun. According to Jerome Powell, the Fed wants the inflation rate to be around 2%, but it's definitely not the ground reality now, is it? Just last year in June, the inflation rate peaked at 9.1%. Since then, we can say that it has come down and is 6% at the moment, but this is way above the 2% the Fed wants to be at. If the inflation remains significantly higher than 2%, the Fed will keep increasing the interest rates in order to bring the prices down. The most significantly hit sector is real estate investors here. Why? Well, let me explain. Traditionally, the U.S.-backed Treasury bonds used to gain much lesser profits than the high-profit rental income market. So the big investors used to make tons of money by buying rental properties and renting them out. But as the interest rates have been on the rise, so has the profit on Treasury bonds. So much so that the profit yields of rental income cap rate and 1-year Treasury bonds equalized in February, as seen here in this graph. The Treasury bond yield reached a 5% level due to the continuous interest rate hikes, which are now higher than the cap rates of owning rental properties. Now, think about this. Why would an investor risk their money in rental properties for a lesser return than buy a Treasury bond and get a better return? They wouldn't, and that's what's happening. Owning and keeping real estate properties requires supervision, and the investor has to put in some effort to keep it profitable, whereas if you own a Treasury bond, you simply sit on your couch and yield the profits. During the fourth quarter of last year, investors bought $31 billion worth of homes, which is a 45.8% record drop over the year. This clearly shows how the investors are now looking and actually buying other asset classes that are offering better returns, such as the government-backed risk-free Treasury bonds. In other words, we can say that real estate is currently a bad investment. Also, many are still in denial that anything bad is going to happen to their investment. Let me explain that further. In the psychology of a market cycle, there's a denial phase where investors refuse to accept that a market correction is occurring, despite clear evidence to the contrary. This can occur after a prolonged period of growth and optimism. During the denial phase, investors may ignore or dismiss negative news and data and continue to invest heavily in the market. However, as the market correction continues, the denial phase eventually gives way to panic and fear, leading to a rapid decline in market values. Now, this denial phase gives way to panic, and eventually the crash will occur, and this is likely to happen when we see an increasing unemployment rate. As of right now, the unemployment rate may be at a low 3.6% level, but the news we hear every now and then tells us the number of massive layoffs that so many companies are undergoing. Even some of the biggest names like Meta, Disney, Zoom, Dell, PayPal, IBM, Spotify, Google, Microsoft, Amazon, etc. have seen a large number of job cuts, which is only going to increase as we move ahead in 2023. One thing you may have noticed is that these layoffs are mainly in the tech industry that pay high salaries, the white-collar jobs. Have a look here. Only in January, the number of employees that lost their jobs in the tech field was almost 140,000 in 269 companies. This increase is huge if we compare it to the figures in December of 2022. Now, when there's a high number of job cuts, it's going to directly impact general consumer spending. The job cuts will definitely slow the spending rate because of the high inflation and high mortgage rates, so how on earth will the average American consumer be left with any savings? According to the data, there is a significant drop in the personal savings rate of the average American. It used to be 8% on average, but right now it's dropped so low, reaching 4.7%. This number was even at 2.7% in June last year. People are even resorting to debt now. In fact, the current graph of consumer loans in the U.S. is going up and reaching almost $1 trillion. Plus, it's not showing any sign of slowing down, which is even more problematic. This means that people are resorting to debt and loans in order to keep the house running. So all in all, the likelihood of a crash is high as Americans are struggling to pay their existing bills and are unable to secure loans for super expensive homes.